Sanjay Dutt, Director of Quantum Securities, joins us right now on the show. Sanjay, good to have you. Thanks so much for joining in. What's the sense, Sanjay?
Thank you for having me.
Of course. We've ended the March series on a bit of a disappointing note, but the optimist would say that, hey, two consecutive series where we've gained almost 10 to 11%, so this was probably warranted. What do we do in April now?
I think, if I'm correct, I haven't gone and seen the data in the offices yet, but this is probably one of the lightest series we are coming into, particularly in terms of stock futures, individual stock futures. And that to me is a very positive sign, because we had a lot of long positions being built last month in the anticipation of the budget and the RBI policy and policy action that people were expecting. And of course, all those expectations weren't really met. In fact, the other way around, we had some disappointment on the tax front, etc. So from that point of view, I think we're coming in very light into the series. We have the RBI policy here, and to me the silver lining is that we are seeing oil that's coming off in the last 2 days. I think it's down about 5% or 4% in the last 2 days, and there is genuine global concern on high oil prices. And if the combination of the two, that's RBI action in April as well as oil prices cooling off, and an extremely light market as far as the speculative side, I think we'll have a reasonably much better series compared to what we had in March. The correction that we had, correction that was long overdue from the 1,000 point run up to the lows that we saw in August, September, has also taken place. We are finding good support of the 200-day odd moving average. So I think we are quite well positioned now.
So Sanjay, what about the first trigger, that is the central bank? Do you think it is going to be a very decisive policy at that from a market perspective? And do you think the central bank is going to go out and cut rates aggressively this time?
I think a 50 basis points is a good chance in the April policy. There have been absolutely clear and explicit statements coming in from the finance ministry and from the government that the RBI would take action to ensure that liquidity as well as cost of liquidity is handled for the industry and for business. And I also see that once the parliament goes into recess now, that's tomorrow, over the next 3 weeks, some of the plaguing issues that have been affecting us in terms of tax, in terms of clarity on GAR, etc., some of them would be addressed to an extent. I'm not saying that the GAR will be completely scrapped, but I think some amount of panic that is there in the market in the last week, 10 days amongst investors would be sorted out. And a combination of these along with the oil prices coming off would be a good trigger for April.
Let's talk about specifics. Let's start off with say maybe banking, which has been the biggest drag in the series gone by. RBI activity probably expected. You did mention a 50 basis point cut as well that could come about. You think that augurs well for banking in general? And would you be a buyer into banking names?
Yeah, definitely. Because, if you note one clarity that came in from RBI yesterday, and RBI is one of the very few central bankers in the world who will not make a statement so casually or would think 10 times before actually making a statement. And that statement specifically pertained to their concern on the NPAs, because the banks have been dragged down not only because of the interest rate and other liquidity issues that have been plaguing them in the last few months, but also because of a large concern in terms of huge NPAs, various figures of 1 lakh crore, 2 lakh crore being thrown around in various sections of the media. But RBI clarified yesterday that the NPA position isn't as bad as what probably is perceived to be or made out to be. And if that be the case, and we have a benign interest rate environment coming in with liquidity being sorted out and banks not having to really offer such high deposit rates as well as cost of funds coming down, I think the banking sector looks pretty well positioned for the next 6-12 months. I at least wouldn't want to be short on the banks at this point of time in India.
Sanjay, in your previous answer, you just briefly mentioned about the GAR fear. Do you think there is still a fear somewhere that perhaps there could be significant unwinding of P-notes as well as ETF money, or do you think now the finance ministry has pretty much eased out all the concerns?
Finance ministry hasn't really eased out all the concerns. We still need a lot of clarity as to what exactly would happen in terms of retrospective effect and the criteria, the 4 criteria that they specified. We definitely need clarity on that. And I think more than anything else, what markets looking for is that government needs to clarify that this would be applicable from a date, say 12, 18 or 24 months from now, and not that tomorrow morning that you shift from Mauritius to Singapore jurisdiction, etc., etc. So those kind of issues still need clarity. But to say that there will be massive unwinding immediately, I don't think so. Mainly because of the fact that I think government's pretty well concerned about this. They're taking stock of it. They had their concerns because the parliament was on, and I think in the next 2-3 weeks they will address the fears that most institutional investors, investment banks and others have clearly pointed out. There's a lot of international publicity, in fact negative international publicity on this issue also that's there across respected journals and respected newspapers. And government is really in control and knows what's happening on this. I'm quite confident this will be addressed in the next few weeks.
Would you, Sanjay, would you buy distress right now? I mean, there is distress seen on the large cap end as well. A lot of these stocks like a Jindal Steel and Power, for example, which has gone through some turbulent times in the last few days, never mind what it did yesterday. But a couple of other names as well, maybe in the power space as well, which are going through some distress. Are you buying distress in the large names?
Yes, definitely. I think stocks like Reliance at 720, 690 odd that's being talked about, or 730 that's being talked about, what's the price now? Also, like you mentioned, JSPL, a lot of power sector names which I think are in the process of getting their fuel linkages, etc., sorted out. Yes, there is a back and forth going on the coal issue, the FSAs, etc., etc. But I'm reasonably confident. In fact, I'm more than confident that even the gas pricing issue, for which the arbitration notice for Reliance expires middle of April sometime, I think even that would reach some kind of an amicable settlement between the government and Reliance. And I think there are a good amount of triggers, because most of the there's so much of negativity around right now, whether it's related to GAR, whether it's related to policy inaction, whether it's related to nothing happening in the budget, politics being negative, the rail budget fiasco. I think everything's been hit at the market, and what I'm really surprised is the market's been resilient and has held out to that 5100 odd level. So I think there's a good chance that as soon as most of the issues getting resolved, markets would slowly start inching up. I'm not saying that it's a runaway rise from here. It's going to be a slow and steady climb. But to say that the market's going to fall off the cliff and we'll see 47, 4800 soon, no, I don't think so.
Sanjay, you've been a careful observer of the real estate packet. Is there anything that you like there or dislike there?
I don't like the sector as yet, but the sector would get a pop in the next few months, because as soon as the interest rate environment, as soon as the rate cycle environment turns to the positive, a lot of projects, a lot of financing, a lot of consumer end financing for housing loan is going to get sorted out. So therefore, you would get a short-term pop. But I think there are a lot of fundamental issues from the demand side, demand-supply side. There are a lot of pockets across the country that still need sorting out, that still need some amount of inventory to be run down. Till that is not done, I don't think sector as a whole one can call as having, getting set for a run-up. Select stocks which have no debt in their books, which are still managing to hold the price line in various markets, would obviously stand out and do well. But as a sector, I don't think anything has changed fundamentally for the long term.
Because Sanjay, it's a very small pocket. I don't know if you track it also or not. Just a couple of stocks in the listed entity, but they've been through some carnage, the gold finance companies. Do you look at these at all? I mean, or is the business model completely shattered, or now after the correction, it's a good level to probably buy at because business is still there?
I don't think it's really something that's worth looking at. I would rather focus on the broader, well-diversified NBFC models, because I think they have much more potential than purely gold loan-focused entities. I think they run the same risk what the microfinance business had, because if you look at it, the kind of loans being given out in the gold segment are again those small ticket loans to the lower middle class, in that category of borrowers. and that particular community, that particular borrower category is always got issues. So I'm not comfortable being in that sector. So I would prefer a broader NBFC play versus a pure gold loan play. I think they've had their heydays. They would now not do much, barring an occasional pop for a few months here and there.
Even that's a fairly wide spectrum though, Sanjay. I mean, there are infra finance companies, there are NBFCs for insurance, so on and so forth. What is it that you like?
Yes, you correctly said that that's a very broad space. I think in each space there are leaders where one can look at. There are a lot of holding company structures which have cross-functional, segment, cross-domain businesses who have NBFCs, who have mutual funds, who have real estate finance companies. Those would be, I think, good plays to look at. Then, of course, you have pure home loan finance focused companies. Even those are pretty good to look at. I think within their pockets, each one which is specializing in a particular area and is maintaining margin, has understood the domain and is in totally control of its book, primarily in terms of stress asset management. Those are the companies one look at. I would happily look at a company like Reliance Capital, India Bulls Finance, the Shriram Group, L&T Finance, for instance, at more attractive valuations. Some of them obviously have positions, so I would like to make a disclosure. But one would look at select pockets and definitely take exposure on these, because along with banking, I think this sector has tremendous potential in the country over the next 2 to 3 years. I cannot say what will happen in the next 2-3 months, but otherwise I think there's a lot of potential.
Sanjay, you've talked about oil and gas with Reliance, but what about the other end of the commodity spectrum, metals?
I think metals is really a wild card because it's got so much of influence, out of international prices. Obviously, that's something very naive and stupid I'm stating. But I think China is the biggest wild card there, what I mentioned, because the jury is still out on what exactly is happening on China. How is China going to handle whether China is going to have a hard landing or China is going to manage itself in cooling off and a soft landing, and then once again handling growth. If China collapses and metal prices start to collapse, I think there could be some amount of pain in the sector. So it's something that's very difficult to game because it's a lot linked to international prices. And also I think we have a major contradiction within our own market in terms of commodity prices as inputs to a large number of companies, and inflation, and commodity prices in terms of pricing power to companies where we invest in, like the Hindalcos and the other companies in the business. So at this point of time, I would be cautious of the metal sector as a whole, both ferrous and non-ferrous, because I think the consumption story would be better placed. I will see the commodity prices remaining soft or remaining a little cool, barring, of course, China starts raging again and we once again have a commodity boom across the world, very strong prices, then I think one would have to relook at the hypothesis that I'm stating.
Sanjay, if you can share names, that is. I know you also at times scan the larger universe and come up with a few hidden gems. Anything that you unearth which seems to be a promising story from a year and a half, 2 year perspective?
Nothing specific at this point of time, but I'm very optimistic on the financial services space, as I've clearly sounded. And within that, some of the NBFCs, the broader holding company kind of structures look very exciting, because I think in the next year or two, a lot of unlocking of value, a lot of investments would happen in insurance sector. ICICI has an excellent insurance business. Reliance has an excellent insurance business. Similarly, some of the South-based NBFCs have, again, good insurance and broader NBFCs within their structures. Bajaj Holding is another exciting company. I don't have a position in there, but I think that's something which could pan out to be a reasonably good company. So within these companies, I think one should look at, and they can still be multi-baggers. And of course, capital goes in the engineering space. I can name, tens of companies in the sub $200 million, $100 million market cap range, but have top lines 2 or 3 times that, and no one's looking at them and they're languishing. I think once the investment cycle and the rate cycle turns, these companies are surely going to be multi-baggers. One should start looking at them, particularly in the BSE 500, some of the, lower tier companies, but with good quality management and very good models and relatively less leverage.
Okay, Sanjay, so good to have you on the show. Appreciate you taking the time out and joining us today on ET Now.